In today's webinar, Exit Planning, the Key to a Successful Business Owner Transition. My name is Patrick Crosby, and I'm a Senior Tax Accountant at GRF CPAs Advisors, formerly Gelman, Rosenberg, and Friedman, and I will be today's moderator. I'd like to start off today with some quick housekeeping items and explain what you will need to do to earn CPE credit. Participants seeking CPE credit today must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. You will be asked to recall these words in order to receive credit. Please write down the CPE words when they are given and keep them until you receive your certificate. They will not be provided again. If you have any technical questions or issues during the webinar, please use the questions function to speak with our webinar administrator for assistance. The slide deck and recording from today's webinar will be available for download at the link shown here. You will also receive a follow-up email with direct links. Technical support and CPE questions may be addressed to Dominic Acosta at dacosta@grfcpa.com. Today's learning objective is to provide attendees with a better understanding of the 6 critical elements to successfully selling or transferring a business, and to come away with the knowledge to begin their own exit. 1 CPE credit is available for this webinar. I would like to introduce your presenters for today's webinar. Walter Dial is a partner and the director of GRF's Tax and Exit Planning Consulting Division. Walter addresses particularly complex tax issues with clients concerning investments, estate, and gift taxes, with a specific concentration in helping business owners transition their businesses. Pat Ennis is the founder and president of Ennis Legacy Partners. With decades of experience in financial services, for-profit and nonprofit leadership and management, along with the founding of ELP in 2010, Pat has extensive knowledge and understanding of the many challenges faced by business owners. I will now turn over the presentation to Pat.
Thank you, Patrick, and welcome, listeners. Thank you for joining us today on the webinar. Our goals for today's presentation include raising awareness around decisions, problems, planning challenges most every business owner will face pertaining to their eventual exit, and then recommend a solution, which we are going to refer to as exit planning, and then describe in detail the critical elements of a successful exit plan. And we'd like to begin this presentation highlighting what we have found to be common characteristics of our business owner clients. First, like the owners that I met with this morning, first thing this morning, built a business over now 3 generations, and they've had significant impact in serving many people. And the impact, begins at home with their own family, but then extends quickly to employees and their families, customers, vendors, suppliers, the community, local and national economies. The impact of a successful owner is significant, broad and deep. And because they've had such impact, perhaps for decades, like these gentlemen I met with this morning, their personal identity can be very closely tied to the business. And this can result in uncertainty about what life would look like after the business, and then procrastination in planning for life after the business can also result. Their business is typically expected to play a key role in retirement planning, as it is often their largest asset. And because the business is typically the largest asset, business owners can often be neglected by the wealth management community in regard to financial planning, which can result in a back-of-the-envelope financial plan. And it's not unusual for small business owners to invest more time working in the business than they do working on the business, which results, again, in some deficient strategic planning, if you will, for business growth and exit. So it can be quite common to find a business owner who is put off thinking what they should do after the business or life after the business. Common to see a back-of-the-envelope personal financial plan, deficient strategic planning about business growth, and And then also that most impactful event in the future, their eventual exit from the business. And then a characteristic, we absolutely know this to be a shared characteristic with all business owners. 100% of them are going to stop being business owners at some point. So now Walter's going to describe some of the challenges or problems that owners are facing in planning for this most significant event, their eventual exit.
Thanks, Pat. And the problem that we're talking about is that most business owners will not be able to exit their businesses on their own terms and conditions. And what we mean by this is that most owners are not going to get the amount of money that they expect, need, or want. And they also may not be able to transfer the business to the party whom they had hoped to. When that happens, not only are they not reaching their financial goals, but there could also be other value-based and legacy goals that are not going to be realized. So we would term that to be a bad exit, one where the owner is not exiting on in his own terms and conditions. And we generally see 4 specific reasons for this. So we're going to go through all these separately, but let me just give you an overview. So the first is lack of planning. And as Pat mentioned, most of our clients are owners of small businesses, and we see how hard they work. And like Pat mentioned, it's, they're generally working in their business, not on their business. And it's not much different for me and Pat. You come to the office, before you know it, there's an email, and all of a sudden your plan to sit back and actually do some strategic planning for the day has gone up in smoke, and you're satisfying your clients. So we certainly understand that. The second one is what we call the misperception spell, and we're going to go ahead and discuss that more in detail. But basically, it's just owners have some misunderstandings about what they're going to get out of their business and how much they really need to retire successfully. And then lack of experience selling a business. We're going to talk about that one. It's kind of obvious. Most business owners have one business and they don't have experience selling a business, so that can be an issue. And then finally, just the timing of the sale itself. It could be that when it comes time to sell the business, it's a buyer's market, not a seller's market. So we'll take a look at that also. And we're going to be discussing some solutions to these problems. One thing to keep in mind is that it could be that there's only one of these problems that exist, or it could be all 4 at once. If it's all 4 at once, you're probably going to go from a bad exit to a really bad exit. If it's just 1 or 2, it may be a bad exit. But the good news is there are solutions, there are ways to avoid these problems. So let's go ahead and take a look at those specifically. So the first one we mentioned was lack of planning. And the Business Enterprise Institute did what they call an owner survey back in 2016. And these are the results they found. 38% of business owners haven't taken any steps in planning their exit. Only 27% had calculated how much money they needed to get out of their transfer. Only 24% had hired and trained employees to successfully take over the business. Only 22% had a current business valuation, and only 17% had a written plan. And these statistics, although they were nationwide, they pretty much mirror what Pat and I see when we work with clients. The good news is there's an obvious solution to this, and that is making planning a priority and actually getting started to do something. And we'll talk about how to do that more in detail later. So the second area we talked about was what we call the misperception spell. And this comes from John Brown's book called Exit Planning, the Definitive Guide. And he highlights 5 different misperceptions that business owners often have. And again, Pat and I can certainly concur that we see this a lot with our clients. So the first one is that business owners often underestimate the amount of income that they're going to need after their exit. So what we see is, there's some popular kind of planning tools out there. Like I think I read one that says, well, you take 75% of your current spending and that should be good for retirement. Well, what we actually see is that, these rules of thumb really don't apply very well. So for instance, especially in the case of a business owner. So for instance, many business owners are surprised that within the first couple years after their exit, their expenses actually increase rather than decrease. And this can be explained by a couple of factors. One is oftentimes expenses have been paid by the business that are now having to be paid personally. So for instance, there may be autos in the books or on the books, and the auto expenses are running through the company. There's going to be some travel and entertainment, cell phones, other types of benefits, maybe health and life insurance premiums, that type of thing. So all of a sudden, a fair amount of expenses that the business owner really never thought of as part of his budget are now going to become part of his budget. Travel with family or around the country to see family is another popular expense that seems to pop up and increase in those first few years after retirement. So again, that first one is just that business owners tend to underestimate the amount of income that they're going to need in retirement. The second one, which kind of goes along with that, is oftentimes business owners incorrectly assess the rate of return they're going to be able to earn on their investments. So, a lot of times people will say, well, the stock market, historically returns 6% or 8% or whatever it is. Well, as you head into retirement, chances are you're going to reduce the risk factor of your portfolio. That's going to mean transferring assets out of equities and into fixed income. As soon as you do that, your expected rate of return is going to go down. So oftentimes business owners don't take that into consideration. They tend to have a more optimistic view of what their returns are going to be. So that's something that needs to be adjusted. Another area is just the value that owners assign to their company. So I would say, if not 100%, I would say 95% of the business owners that Pat and I work with, when we first meet them, they definitely think their business is worth more than it is. And it's kind of an easy explanation for this. They tend to look at their business as the amount of money that they can take out of it as salary. Well, when they go to sell their business, the buyer is looking at it more as an investment. So what he's looking at is, how much cash flow is the business going to generate? What is his return on the investment going to be? And that's going to be less than the salary that someone is taking. The other thing is, business owners will often just kind of estimate the value of their business based on maybe what a friend sold their business for. And you really can't do that, because industries are completely different when it comes to multiples and values. And every business has its own specific characteristics that either make it more or less valuable. So really the only way for a business owner to really fully understand the value of their business is to have an official business valuation performed. Another area is the growth rate that business owners predict for their business value and cash flow. You need to keep in mind, businesses cannot grow at 5 or 10% forever. If your little business was able to do that, it would be bigger than Apple in like 20 years. So business owners just need to be a little bit more realistic that, yeah, you can grow pretty fast in the beginning, but at some point you're going to start to plateau out and just reach kind of a lower but sustainable level of growth. And then the final area, and this is one, again, that we see all the time, and I think it really surprises business owners, but that's the net proceeds that they can expect from the sale of their company. So oftentimes a business owner may say, yeah, my business is worth $3 million. And that's kind of in their mind, that's what they're figuring they're going to take home. Well, right off the bat, they're probably going to lose close to a third of that to taxes. Now we can do some planning to mitigate that, but they're still going to lose 20 to 30% right off the top to taxes. And then of course there's costs of doing a transaction. You have legal fees, other professional fees, maybe a finder's fee, that type of stuff. So net proceeds are oftentimes 60% of what the gross value of the company is. One of the other problems we highlighted was just that business owners don't have experience selling a business, and that's just common sense. Most business owners, they started a business and they've been in it, and that's what they do. They've got their one business. They've never really sold a business. If they have, maybe they've sold one or two, and usually they've been fairly small. If they're going to sell to a third party, chances are that third party is an experienced buyer of businesses, and he has a team assembled. He knows exactly the strategy to squeeze the seller and get the best value on the buy side. The seller is not going to have those same skills. Now, fortunately, the easy workaround on this one is that the seller of a company can simply make sure he has a good team in place. You know, you can hire a good CPA, a valuation person, an attorney to do the deal, business consultant. All those, you know, all those positions are available out there, and there's people willing and ready to help. And then the final problem we talked about was just the timing of the sale. It could turn out that when you decide you want to sell your business, it's a real buyer's market. And we don't necessarily mean just in your industry. If you just look at the demographics, and they're on this slide here, there's a lot more a lot more sellers of business than there are buyers. And some of that has to do with the aging of the baby boomers and some other factors. But you know, 80% of businesses will end up not selling. So most businesses are not going to be able to sell, and their owners are not going to be able to retire on their own terms. Again, there's, you know, the way around this one is really just through planning. If you've got a plan in place, it's going to offer you more flexibility, because you'll know your time frame, and if for some reason it seems like the market has shifted on you, it's much easier just to take the existing plan and adapt it for another 2 years or something like that until the market changes again. But this is a very important one to realize, that just because you want to sell your business doesn't mean you're going to find a buyer who's willing to buy it, and definitely not necessarily you're going to find a buyer who's going to buy it on your terms.
So what's at stake? Well, there's a lot at stake. I started today talking about the impact an owner has on so many people. All of that's at stake, when and how an owner actually leaves the business. And a bad exit from your business can result in, we give you a list there, it's not exhaustive. Financial hardship for an owner and their family. An example might be an unexpected death or permanent disability with no plan in place, leaving the family in financial trouble. Or maybe because the owner didn't build a business that's sellable for the amount of money that they're going to need or want, they cannot sell the business for what they need or to accomplish all their goals. An owner's post-exit financial and values-based goals may not be realized. Perhaps an owner ends up liquidating for asset value, when what they really wanted to do was transfer the business to their key employees or children. Big tax bills, of course, Walter's already referred to that, due to a lack of planning, not uncommon. Minimum sale price may be realized because maybe the business runs too much through the owner and they don't have a management team in place. Perhaps the owner experiences a lack of control when selling the business, because the buyer ends up having all the leverage in the deal. Maybe the business, the way the business is eventually sold or transferred results in family discord or disharmony and conflict. It's not unusual for a company's culture to be damaged or even destroyed when and how an owner leaves, and the culture that the owner built may be one of those values-based goals that they wanted to protect all along. Key employees might leave during times of transition and uncertainty if they haven't been incented to remain, or if there isn't a clear plan forward. This can devastate an owner's exit plan. And at the end of 20 or 30 years, an owner may be forced to liquidate for asset value if there hasn't been sufficient planning. So you can see there's a lot at stake. And again, this list isn't exhaustive. But we have good news, and Walter said it, and we want to continue to say it. There is good news. There's a solution, and we're going to talk about that. But before we do that, Patrick has our first polling question.
So we've come to our, we've come to our first polling question. The question reads, do you have a written exit plan? A, yes. B, no, but have thought about getting one. C, no, and have not thought about it. So please take a moment now to answer. While participants are submitting their answers, I'll provide the first CPE word. The first CPE word is exit. If you want to receive CPE credit, please jot these words down because you will need them for this survey following the webinar. Again, the first CPE word is exit, E-X-I-T.
Thanks, Patrick. So we've gotten our polling results. 14% of our attendees actually have a written plan. Good for you. You're well on your way. 71% no, but they've thought about getting one. So maybe this webinar will spur you to take that next step. And 14% no and have not thought about it. So hopefully we can at least get you thinking about it by the end of our webinar today. Thanks for taking that poll.
Yes, thank you. So we've reviewed the problem and from a few different angles and considered what's at stake when and how an owner leaves. Now let's look at our proposed solution, exit planning. In his book, Walter mentioned John Brown earlier. He's written a few books on the subject of exit planning. In his book, How to Run Your Business So You Can Leave It in Style, he offers this description for exit planning. It's a process that results in the creation and execution of a strategy, allowing business owners to exit their businesses on their own terms and conditions. It is an established process that creates a written roadmap or exit plan, often involving efforts of several professionals, facilitated and led by an exit planning advisor who ensures that not only a plan is created in the right way, but of its timely execution. So that's what exit planning is, general concept. Now let's take a little bit deeper dive and look at some of the elements that are critical for a plan to be successful. When it comes to strategic planning of any sort, be it personal financial planning, estate planning, planning for growth of your business, there's nothing more foundational or critical than establishing clear goals and objectives. And so that's also true for exit planning. Critical element number one is all about clarifying and establishing owner-based goals. It's all about what you, the owner, want financially, values-based goals, legacy goals. And we typically begin with what we call the universal goal questions. And these are questions that every owner is going to need to answer at some point. And they are this: when do you want to exit? How much money are you going to need when you leave in order to do everything you want to do after you leave? And then to whom would you like to sell or transfer the business to? Is it going to make the most sense for you to sell to a third party, establish an ESOP, sell to insiders, key employees or children? Who are you thinking you want to transfer the business to? So those are the universal goals. And then as important, and to a lot of owners even more so, are the values-based and legacy goals. For example, we had one client, Walter and I helped together, who had a values-based goal of selling his business to his son and his key employee, and that goal was as important to him as his financial goals. Another client very much values personal reputation, family name, legacy, as a business owner in the community, and for those reasons wants to consider those values-based goals as much as any financial goals that she has, and that's going to impact how they exit the business. An owner's goals drive everything, including which exit route they choose. For example, they may begin with an assumption that they will pass the business to children working in the business, only to learn during a planning process that their children really don't even want to own the business, or their children are capable employees, even key employees, but they don't have what it takes after a third-party evaluation, what it takes to be an owner. A lot different being a key employee and an owner. Now, as important and critical as this element is, establishing clear goals and objectives, it often does not get near the attention needed. Well ahead of the time an owner says, quote, "I'm ready to exit." In too many cases, the owner doesn't end up clarifying what they really want until after they leave and experience regrets. Then it can be an all-consuming and not in a good way. So don't do that. Get the help you need now. Start now in clarifying and establishing those goals for life after the business, how you want to exit, what you want to happen. And the sooner you can establish a baseline set of goals to work toward, the better off you're going to be. And by the way, those goals may change throughout the process, as the gentleman I just mentioned who sold to his key employee and kids, his goals change throughout the process, and it happens possibly many times during a planning process over years. So get the help you need sooner rather than later. If you need and want help with this, contact either Walter or myself. We can help you with it. Walter's now going to describe critical element number 2 and the importance of exposing financial reality with an accurate financial gap analysis.
Thanks, Pat. And what you just said really was really good. I mean, I think it was Price Waterhouse or PwC that did a survey of business owners who had sold their business in the previous 24 months or something, and like over 70% were dissatisfied. And interestingly enough, it wasn't due to financial reasons. It was just due to basically their life after selling wasn't what they had planned. So I think that really comes back to identifying your goals and objectives early on, and not just the financial ones. But for critical element number 2, we are discussing the financial aspects. So a gap analysis is really pretty simple. The idea here is, I'll give you an example. Let's say that you go to your wealth manager or financial planner and you ask him to help you figure out what the level of assets that you need to retire successfully. And he comes back and he says, okay, you need $4 million in assets to retire successfully. And he also tells you that he's managing $1 million of assets. You then go and you have your business valued by a valuation professional who comes back and says your business is worth $2 million. So now you've got a business that's worth $2 million, and let's say that's net of taxes and everything else. You now have $2 million there. You have $1 million being managed by your wealth manager, but you need $4 million. So you have $1 million gap. So the worst thing you can do at this point is look for the nearest window and jump out or panic in some other way, because if you look at it, the way I look at it is knowing that you have $1 million gap, even though that, may not be the ideal situation, you're ahead of about 90% of the business owners out there who probably have some type of financial gap themselves, but they have no idea that they have it. They're going to find that out when they go to sell their business. At that point, it's too late to do much about it. So if you're ahead of the game and you're doing an exit plan and you find out you have a gap, that's fine. Knowledge is power. All that does is it helps you to put a plan in place to alleviate the gap. So there's a few ways to do that. And it kind of goes back to Pat and his 3 universal questions of exit planning. But the first one was money. So maybe you go back to your financial planner and you say, hey, you know what? I'm probably not going to get to 4 million. So what can we do on the expense side to maybe scale things back? And maybe there's some easy stuff. Maybe you were hoping to completely fund college education for your grandkids. Well, now maybe you can't do quite that much. Or maybe you were going to buy a vacation home. So maybe now you have to rent instead of buying a home, stuff like that. Another area would be just the timing. So let's say that you were hoping to retire in 2 years. Well, if you switch that to maybe 4 years, that's going to give you 2 more years to save money outside the business and increase the value of the business. So that can make a huge difference financially. And then finally, it could also change who you're going to transfer the business to. If it turns out finances are going to be tight, that means you probably can't gift the company to your children. It means you may not be able to do a sale to insiders, because that's usually resulting in the lowest amount of sales price. You may end up being in a situation where you're going to have to sell to a third party. In that situation, you'll probably get the highest price and you'll probably get the most money up front. So the good news is, even if there's a gap, as long as you've planned ahead so you have time to make the appropriate changes, it's not the end of the world. Everything can work out just fine.
Critical element number 3 is building sellable value, or building a business that someone else is going to want to buy, and buy for the amount of money that you need or want. Sellable value is essential if you want to maximize your options for exit. An owner who has a sellable business has more options for exit. So, and let me just say this here too. of course, we're talking to folks here, business owners here, who want to get value out of their business at some point. Some of you may have lifestyle businesses where you're not expecting to do that. So we're talking to people here, business owners here, who want to get value from their business at some point for retirement or whatever they want to do next. So again, if you want to maximize your options for exit, you're going to have a sellable business. Let me explain what I mean by that. If you have a strong sellable business, you may decide to keep it yourself as an absentee owner, because if your business is built the right way, you're going to experience much more personal freedom today, control, financial benefit. And when that happens, it's not uncommon for an owner to look around and who is thinking of leaving and actually say, you know what, things are pretty good now. I think I'm going to keep it. It's kind of like, you know, when you go to sell your house and you start you put a new kitchen in, you put a new this and a new that in, and then you look around and you think, oh my gosh, I don't know if I want to leave here. It's kind of like that. It can work that way. But so again, strong sellable business, you may decide to sell it to your key employees because the business is strong enough to support an internal buyout without you potentially having to come back into the business. Perhaps you're motivated by the tax benefits and wanting to preserve the culture of your company, so you sell to an ESOP or an employee stock ownership. But you could do that, you could only do that because your business is financially strong, you've got a strong management team in place, you've got a sellable business. Or, of course, you may just say, I'm done, I'm going to cash out and move on to the next thing. In any of those scenarios and others like them, your business still needs to be sellable. For you to have all these options, the business should be strong and value drivers listed here on this page. Buyers want to buy businesses that have strong financial performance and management, revenues that's recurring, proven growth strategy, strong operating systems, financial controls, competitive advantage, differentiation, and scalability. That's what buyers want to buy, and so that's how you can know if your business is sellable, if you're strong in those value drivers there that we've got listed. Let's consider a quick example of increasing your potential sale price and sellability. Let's say you currently have net cash flow of $250,000 and a multiple of 2, which would be based on current strength or weaknesses of the value drivers you listed, and not on current market conditions. The value of your business would be around $500,000. Multiple of 2 times $250,000, and again, not taking into consideration any market conditions. Now, if you're able to increase that net profit or EBITDA to $300,000, just 50 grand a year, at the same time, strengthen those value drivers we have listed there to the point where you can realize a multiple of 3.5 versus the 2. Your business is now worth $1,050,000. You've doubled the value of the business in this example, but keep in mind it's taken investments of both time and money to do that. It takes time and money, you know this if you're a business owner, to build a strong management team and to execute a growth strategy and scale with improving operating systems. It takes time and budget finances to do that. When Walter and I are working with clients to build value, this is what we help make happen, strengthening both the net cash flow and those other value drivers so that the multiple increases as well as the cash flow. So, critical element number 3, remember these things about this element. It's central and foundational to maximizing your options for exit. If you want to have maximum options, you're going to make sure your business is sellable, and it requires investments of both time and money. So now, element number 4, then you're going to want to make sure you've got a team of experienced advisors. You'll see a list there of potential advisors you might need. You may or may not need all of them for your particular situation. The advisors you end up with needing will depend very much on what exit route and plan you create and design and implement. But the key takeaways here in this critical element would be make sure that whatever advisors you have on your team, they're experienced in this kind of work. You'll want advisors with experience and expertise in business succession, transitions, and transactions. And then also, you'll need someone to manage the team in the project. Building an exit plan is a lot like building a commercial building, and you're going to need plumbers, electricians, architects, carpenters, all those specialists. In the case of exit planning, the specialists are accountants, attorneys, wealth managers, etc. Someone's going to need to coordinate that team in designing and implementing the plan the same way a general contractor might in building a commercial building. It can be you, the owner, typically not wise unless you have adequate, sufficient knowledge in all these specialized areas and know how all of these different professionals need to collaborate and communicate with one another. It could be one of your current advisors. Also, in most cases, not wise. It's probably best that you have your CPA focused on the taxes and your estate planning attorney focused on that and so on and so forth, rather than having them do something that they really don't want to do, which is manage the whole process or herd the cats, if you will. Or it can be a trained and certified exit planner like Walter or myself. This choice here will increase the chances of a successful exit and your peace of mind in knowing that the team is operating the way it needs to. If you're not intentional about this, about having an experienced team of advisors and having them coordinated, you could end up with an exit you regret. So begin to evaluate, take a step, begin to evaluate your current advisors and their level of experience and expertise in transition and exit, and build a team that you have confidence in. So now Walter is going to take a look at the importance of a future cash flow estimate.
Thanks, Pat. Yeah, so critical element number 5 is future cash flow estimate. And it's critical for a number of reasons. Number one, your cash flow is the key value driver for maximizing your business value. Pat and I generally work with businesses that, somewhere between $2 and $20 million of revenue. And businesses of that size almost always sell for a multiple of some definition of cash flow, whether it's EBITDA or seller's discretionary earnings or any of the other ones. It pretty much always comes down to a multiple of cash flow. That's what buyers are looking for. So it's a foundational element of business value. The dependability of your cash flow is also going to help determine what is your best exit route. So for instance, if you want to do a sale to insiders, you really have to be confident that the cash flow that business is generating is going to be sufficient for the insiders to buy the company from you. Because normally a sale to insiders, generally the issue is they don't have a lot of money. So the owner is going to be taking back a note. So you want to be confident that your note is going to get paid back. And the way that they're going to pay it back is through company cash flow. So if the company cash flow, maybe isn't that great, you're a little concerned about it down the road, then maybe a sale to insiders is not going to be the way to go. Also, if you were considering an ESOPs, one of the characteristics of a good ESOP candidate is that they have very strong and very consistent cash flows. So, again, the estimate of cash flow can help determine what is your optimum exit route. And then when you look at your own financial plan, the cash flow really establishes the foundation for that. All of your personal financial planning is going to be based on your ability to generate the cash flow to satisfy your expenses and your other goals in retirement. And then finally, things can go wrong with your exit plan. Even if you've planned it out in your mind perfectly, just, life happens. Things happen that could potentially derail the plan. However, if the company has really strong cash flow, that can help you overcome a lot of other problems. So strong cash flow, I really can't overemphasize how important it is in this entire process.
And then time is the last critical element we'll highlight today. Excuse me, but it certainly isn't the least, evidenced by how many times we've already mentioned today in this presentation the importance of getting started sooner rather than later. Because the more time you invest in planning, the more options you'll have, and the greater chances you'll have for success, no matter which of these routes that you choose for exit. Referencing that survey again that Walter mentioned earlier, the BEI Business Owner Survey, 76% of business owners want to exit in the next 10 years. However, only 2 out of 10 will be able to. That number could be much greater than 2 if owners would start planning sooner rather than later. So if you don't remember anything else presented today, and this, I'm sure you'll remember this because we've mentioned it so often, remember to get started sooner rather than later in planning. That way you're going to have many more options and much greater chance for success. So there is a solution. It's exit planning. Just get started on it sooner rather than later. And Patrick, I think you have our next polling question.
So we've come to our second polling question. The question reads, do you have a current business valuation and financial gap analysis? A, I have neither. B, I have a business valuation only. C, I have both. Please take a moment now to answer. While participants are submitting their answers, I'll provide the second CPE word. The second CPE word is gap. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the second CPE word is gap, G-A-P.
Okay, so we have our results. 63% I have neither. 25% I have a business valuation only. 13% I have both. Congratulations to that 13% and the 25% as well. These stats, again, yeah, they align with what we experience probably, pretty much, right? Mm-hmm. Okay, so thank you for that. And let's see. Okay, so, all right. So you're thinking, okay, by now, okay, I get it. I know I need a plan. You convinced me, and you absolutely made the point clearly that I should get started now. So how do I do it? Well, here's a process we've given to you that you can, again, you can either start to try to do this yourself or get one of your other advisors, or you can engage someone like Walter or myself to help you lead it. First, discover or clarify your goals and objectives. Critical element number 1. Complete that financial gap analysis to include a current estimate of value. Element number 2, expose reality. A lot of what we do is all about exposing reality, where you're at currently, helping you to establish where you want to go with clear goals and objectives, and then exposing reality as to where you are right now so that you know what you're really going to have to do in order to get to where you want to go. So assess those business value drivers in critical element number 3 and begin to establish your advisor team. Then in step 2, with your team, decide on the exit route that's going to make the most sense for you to accomplish your goals. Then begin to design a plan and both build and preserve the value of the business. Make sure you do the proper tax planning and have a plan for the unexpected, or what we call business continuity, and begin to coordinate it all with your wealth and estate plans. And then finally, of course, implement the plan with your team. And so that gives you a simple process. If you get going on that, everything else will be revealed along the way as to what you're actually going to need. Walter, you're going to talk about benefits.
Yeah, so there are many benefits to exit planning, just like any other type of planning. I mean, there are always benefits to planning, but specifically for exit planning, there's a few that I can highlight. So one would be, it helps to minimize the risk associated with the sale or the transfer of your business. So if you've got clear goals, you've got a plan in place, you kind of know what to expect as you go through the process, it's going to be a lot less risky process. the other thing we mean by minimizing risk is, let's go back to let me just think of an example where, for instance, the business owner needs to get $2 million out of his business, and that's how, all the planning is done geared towards that. But the business is currently only worth $1 million, and it's going to take 3 to 4 years in order to get it up to 2 million. Well, during that time, there's a lot of risk, because what happens if the business owner passes away or there's some other tragedy? So there's risk in that in and of itself during that time period, not only with the transaction itself, but just during that period when the value is building. So that needs to be addressed as well, and it can be with insurance and some other planning tools that we use. As we've talked about, exit planning is going to help you to maximize the value of your company. It's going to help you maximize your net proceeds, and it's going to increase your exit options. I don't want to keep repeating it, but the more planning you've done, the more options you have as to who you're going to sell it to and when you're going to be able to sell it. And all that is going to end up resulting in you staying in control and achieving your goals, which is really what exit planning is all about.
Mm-hmm. Patrick?
So we've come to our third and final polling question. The question is, which of the following value drivers do you need to strengthen? A, financial performance. B, management team. C, competitive advantage. D, proven growth strategy. Please take a moment now to answer. While participants are submitting their answers, I'll provide the final CPE word. The final CPE word is team. If you want to receive CPE credit, please jot these words down, because you will need them for the survey following the webinar. Again, the final CPE word is team, T-E-A-M.
And the results are, let's see, 50% financial performance. Interesting. 50% management team. 17% competitive advantage, 33% proven growth strategy.
So they selected more than one.
Yeah, right. That's right. Yeah. Okay. Thank you. So
it doesn't add up to 100.
Thank you, my accountant friend. So I was going to say that doesn't add up to 100. Okay. Very good. Yes. Thank you, folks. And then, so in summary, on page 24, we just, we listed out there the critical elements for you to consider as action steps you can take. And then on page 25, you'll find contact information for both Walter and myself. If you need help with any of this or just want to have a conversation, we're both committed to providing a complimentary, no obligation, 60 to 90-minute conversation if anyone's interested in following up on this or anything else related. Just give us a call. And then I think we're going to have some Q&A. Is that right? Do we have time for that?
We do.
So before we wrap up today, we do want to answer a few of the questions that have been submitted by our online participants and any others from the room, if you have any further questions. We have a few here. The first I'll direct to you, Walter. What is involved with and what is the cost for a business valuation?
Okay, so there's a couple different levels of business valuation. So you have what we would call a comprehensive business valuation, and that's one where usually where the IRS is involved, and so it might be a situation where they're going to require that. That would be a situation where, for instance, a business owner is gifting part of the business to his children, or maybe even making a charitable gift of a portion of the company. Those are going to require a full comprehensive business valuation. And those are generally going to range in price from a minimum of $7,500 up to maybe 12 to 15. And they're like the name says, they are very comprehensive. We would look at 5 years of company history. We'd have an extensive interview with company management. We'd be doing an industry study. We'd be looking at what other companies have sold for in that industry and in the geographic location and similar size, that type of thing. So it really is a very comprehensive valuation. However, when we were talking about the gap analysis, we talked about doing a business valuation. And, if you've got the money and the time to do the comprehensive valuation, that would be best. But for a lot of our clients at that stage for the gap analysis, they don't really need that involved of a valuation. So instead, we can do what we call an estimate of value. And what that's going to normally entail is, again, we're going to meet with management because we need to have an understanding of how well run the company is, what the value builders look like, that type of thing. And then we'll compare that to what other companies have sold in the industry and in the area. And we can get that data from a number of sources that we have access to. And that'll give us an idea, be able to sit down with the client and say, you know what, the range that companies are selling for in your industry and at your size is somewhere between 2.5 to 5 times seller discretionary earnings. We think, based on the characteristics of your company, you're probably only at about a 3 multiple. And here's the value builders that are kind of holding you back. And then we could talk about moving forward, helping you increase those value drivers. So that's kind of a long answer, but that's the basics of how we look at a business valuation in the context of an exit plan.
Pat, I'll direct the second question to you. In your experience, does it really make sense for the owner of a small business to attempt to build a management team? How do they even do that with limited resources?
Yeah, great question that we're used to getting. The answer is yes, indeed it does. If they want more freedom today in the business, if they're just at the end of their rope, so to say, and they want more freedom today, they need to do that. And again, like we said throughout the presentation, if you want to have more options for exit tomorrow, if you're motivated to get value out of the business eventually, you're going to need a sellable business, and a management team is important for that, an important element. Now, it may be a small management team, of course, based on the size of your business, and then grow over time. Perhaps 1 or 2 other folks on the team other than the owner or owners. But yes, if they want more freedom today and more options for tomorrow, they're going to prioritize this and build a management team. You know what? One other thought that comes to mind, it kind of relates to this a second ago, is another misperception, if you will, about exit planning is that it's all about the future, where really it's so much about the present in building a team, building a business the right way today. And this building a management team is right at is foundational to that, really. If you want to build a business that is going to be sellable, you're going to have this prioritized.
So Pat, when I think about what you just said, I mean, one of the, maybe one of the, it's a paradigm shift or what you would call it, but there's certain expenses that businesses have, and I think the business owner can look at them just like that. It's an expense. Mm-hmm. But I think when you talk about things like management team and exit planning, they really need to look at it as an investment, because it's money they're going to invest in their company, and if done right, they're going to see a great return on that investment.
Well, yeah, it goes back to that example I gave during the presentation of, $200,000 of net cash flow and a 2 multiple versus just an increase of 50 grand in net cash flow and increasing the multiple to 3.5. The way you increase the multiple to 3.5 is you're going to be strengthening things like management teams.
Right.
And so, boy, look at that. I mean, you double the business, the value of the business just by, with not big, huge, drastic changes. But it does take time, right? It takes time to put these things in place. And all of this stuff most businesses aren't set up financially to be able to do everything at once, financially or budget the time for it. So it's best to do it over time.
Right.
So we have a third question I'll direct to you, Walter. Isn't it usually better to try to transfer the business to employees?
Well, it depends on the situation. I'm thinking maybe the reason that question was asked because the person may just be thinking it's easier, than try to go out and find a buyer and go through all the due diligence and all that stuff. And you'll avoid the issue of not being experienced at selling your company, because if you sell to insiders, they're not experienced at buying a company. But it really depends. So I think selling to insiders, you have to realize that may satisfy some legacy goals, which may be the most critical to the business owner. And if that's the case, yeah, transferring it to employees is great. But you have to realize, if you transfer your business to employees, chances are you're going to get less money and you're going to get paid out over time. So there are you're going to give up some potential financial resources to achieve the goal of transferring it to employees. So, again, everybody's different. It all depends on the goals, and that's why it's so important to have your goals in place. But, I guess, so the answer is, it really isn't usually better, but in certain circumstances, it is definitely the best way to go. It does solve the problem of, if there's no one out in the market to buy your business, maybe you can get employees to do it. But if so, you're going to take a financial hit, which makes sense. If it's not a business that other people want to buy, it's probably not that valuable.
Yeah, let me just add to that. That's well said. A serious consideration needs to be whether or not the employees are qualified to be owners.
Good point. Good point.
Because if the deal is like an installment loan over 10 years or something, right? Well, they're in. Yeah. And the employees were phenomenal employees, but they turn out to be not so much as regard to owners, because it's a different thing. Owning is different to being a key employee. The owner could potentially have to come back into the business.
Right.
So you can't be too careful, can you, about evaluating those key employees as to whether or not they have the potential to be owners before you actually sign all the docs.
That's definitely right. Yeah, for sure.
Great. If you have any additional questions after today's program, please reach out to us. Our contact information appears here. And with that, we would like to thank everyone for attending today's webinar. We encourage you to follow us on social media at GRF CPAs and at NSLP. Also, please visit our websites at www.grfcpas.com and www.nslp.com for upcoming events and alerts. Please remember to complete the pop-up survey that follows if you would like to earn CPE credit for attending today's webinar. Thank you again for attending, and have a great day.